In this video, traders, we're going to look at 4 ways to use the 20 period EMA. Stay tuned. Hey guys, so moving averages, you know, can be pretty useful. Some people, I feel, put a little bit too much weight on them. Some people use them, I think, in the right way, which is kind of guiding you and adjusting you and adding them to specific strategies only. So 20 period to me is my favorite moving average. If I could pick one, 20 period EMA is my favorite. I know a lot of other traders use that as well. 10, 50, 100, 200 is all very, very common, but the 20 seems to get a lot of love, and I like it as well. And specifically like the EMA as well, because the exponential gives a little more weighting to price nearby, which for me, I just feel is better. Now listen, SMA is going to give you a very similar kind of price pattern, and people who say you've got to use one or the other and you're not profitable if you use one or the other, it's nonsense, guys. You just plot an SMA and an EMA and look at the difference. Yes, sometimes there's a reasonable bit of difference, but is that going to affect things much? Probably not. But I just prefer the EMA. I've just always had it like that, so I'm going to just stick to it. But if you want to use SMA, then go for it. Okay, so the first thing is the opening drive pullback on a 1 minute chart. You day traders, you know this one. If you're trading specifically the indices or a stock, off it goes, rockets into the upside, a good place. And if I get a blue pen, because I always have to have my 20 period EMA in blue, that's my just superstition. But for example, you have, I've got that on the screen, okay, yeah, good. So you have the opening drive, it starts to kind of pull back, and often it will pull back to this 20 period EMA on a 1 minute chart, and that's very often a good time to get in for the next drive higher. So opening drive pullback on a 1 minute chart, 20 EMA, good thing, good kind of way to use it. Another one is to use it as a mean for your Bollinger Bands. Self-explanatory, but it's there for a reason, guys. People use the 20 period for a Bollinger Band. I prefer, again, the EMA setting if I can. If it's just SMA, I'm not losing any sleep over it. But a Bollinger Band, as we know, standard deviations around a mean, and that mean being the 20 period moving average. It works nicely on a daily chart. It works nicely on a 1 minute chart as well. It's just good. And people use Bollinger Bands, obviously, to kind of restrict the movement, and it works nicely in a range band environment. That's only really the time that a moving average, to me, works nicely in a range band environment, because when it's range bound, moving average tends to be flat, so the bands are around it, and then of course, as you start to excursion away from it, it's like enough, and then it stretch pulls back down again. So it's quite a nice way of channeling price under the right conditions. And some people like to use it on a weekly as well to really widen it out, so then you're trading, if you're swing trading, you're waiting for that extension that just starts to fail a little bit, and then look for a short back in, and using that mean, that 20 period, as a price target when you're using the Bollinger Bands as an entry point. All right, so that's the second one. Number 3, as a benchmark for reversal on a daily chart. What do I mean by this? I'm gonna have to draw this one up for you guys. Let me get my cleanest cloth in the world, and we'll draw this. So what I mean is this. So if you're on a daily chart and you've chugged up and you're kind of coming back and you're doing this, the 20 period is most likely to have done this, okay? Now, the reversal, benchmark for reversal, slightly different to this one, weekly wick alert. Benchmark for reversal is when you start to consolidate, and it almost feels like the 20 period is starting to flatten out a little bit, which it will start to do as price starts to do that, as a potential sign that you may well be coming off of that move. It might not be a trending condition, might be whatever condition is, but that might be a sign that, you know, that move's done with, and we're going to kind of push back down. And if you want to use a lower moving, a higher moving average, and you can do, and that's going to kind of will run along here, wouldn't it, for example. But the fact that it's consolidated under is your first thing, and the second one is the fact that now that moving average is starting to flatten out, not quite curling down yet, might give you a signal that this area here is an area where you need to look for a reversal pattern to get into the short, or flip it on its head, getting into long side. So, you know, it's a benchmark for reversal. Again, the daily chart on this one is not so good on the short time frames, but it's quite good to look at on a daily. Okay, so the fourth and final one is weekly wick alert. And if I put that on the chart as well for you guys, what I mean by this, use a weekly chart, again, 20 period EMA on a weekly, which would be 20 weeks worth of data, all right? What we're looking for here is, as price is pushing up, it comes back down to it on a weekly chart, similar to the opening drive pullback on a 1 minute chart, but very often price, I've noticed this I don't know why this is on a weekly so much, but maybe it's just the markets that I've been looking at. Very often we get a little wick underneath and then a push back up, and then it kind of reverses a bit, and then it might come up and you might get a wick over it again. Very often what I'm saying, guys, is that the weekly wick alerts, weekly wick, is that when either side of the moving average, price tends to put a wick in just above or below it. If it's come up to it from a kind of excursion below or come down to it from a reasonable high, as it's coming to it, trades through it for a few days, like Monday, Tuesday, Wednesday, then comes back for that late rally on the Thursday, Friday, giving you that wick, signifying that the next week potentially is going to be some follow through to the upside if in case of a downside wick, or the other way around. So just watch out for that, guys, using that 20 period and in combination with a wick on your weekly chart. Now, if you're not a longer term trader, swing trader using that time frame, that's fine. What you can do, what I've kind of started doing, is using that as a kind of a guide to say, okay, well, we've wicked through that 20 period, and you know, Monday, Tuesday, Wednesday, like I say, Thursday, Friday. So maybe now I want to try to position on a Monday and Tuesday after that wick to the long side, because I think that for whatever reason this might push up based on that. So you could use it two ways, one for the swing trading perspective or one for guiding your day trades. Okay guys, if you've got any more comments in the comment section below, always interested to learn from what you've got, and something that opens my eyes to stuff that I have not looked at. Maybe I'll do a video on it. If you've got any questions, comment section below. If you like this kind of stuff, thumbs up, like, share, comment, all the kind of stuff that we like to see on the channel, and appreciate your subscription if you are a subscriber. 4 ways to use a 20 period EMA. Take care, bye bye.